So good morning and welcome to our 10 minutes at nearly 10 o'clock. And today we're going to talk about directors' payroll and DLAs. So today we're just going to give you an introduction to directors' payroll. So I'm just going to minimize my screen and move that over. So we're not going to do a screen share today. We're just going to talk you through the basics. So what is director's salary? So a director's salary could be called director's remuneration. It's usually processed through the PAYE scheme with tax sometimes deducted at source. Although often with director's payroll, the whole point of processing this through payroll, through PAYE scheme, is that we're not actually deducting tax because we're only going to run the director's payroll to the tax threshold. So this is not the same as dividends. So dividends are unique to the directors and are processed from profits after tax, whereas directors' payroll can be paid out of overheads and it's a tax deductible expense. It also doesn't matter whether you're making a profit or a loss, you can still process directors' payroll. So for the super tiny businesses that are making minimal profits or just up in startup, this allows you to take a little bit of director's salary out of the business and not having to worry about dividends from after-tax profits.
Now, why do we do this via payroll? Well, it utilises your tax-free allowance, which allows for the most tax-efficient approach. So that's why Lisa mentioned that you may or may not have to pay some tax. Really, at the most tax-efficient approach, you wouldn't have to pay any. But of course,
it
depends on your tax code and HMRC.
Yeah.
As well as this, it also entitles you to national insurance benefits, which you don't get if you took 100% dividends out of the business.
Yeah.
So that's a really key one. And of course, as mentioned, payroll costs are tax deductible as a business expense. Dividends are not tax deductible.
No.
They are definitely not. So please don't get the two confused.
If they're sitting in your overheads, move them out. They should be below the operating profit line. And that's a common error that we often see in profit and loss accounts when we see new management accounts.
Yeah. And as well as this, if you're not physically, say you're running payroll and you're not physically taking the exact cash ran from payroll, you can actually offset the net pay against an overdrawn DLA.
Yeah.
So really useful there, because if any of you do have an overdrawn DLA, you'll know how sometimes it can be quite tricky to clear down. And actually, if you run payroll, it can make this task much, much easier. And as Lisa mentioned, this can be run regardless of whether you're currently making a profit or not. Really important, because dividends can only be taken if you are generating a profit after tax. So big importance there.
Yes, very much so. So what are the costs of processing payroll? Well, probably not very much at all, really. It's going to cost you a little bit of time and effort in doing the admin itself and pushing that payroll through. The software costs are there. If you were doing zero payroll, it would cost you a minimum of £5 per month. But the advantage of using a zero payroll if you're a zero customer is that that's all included and it's all part and parcel of your zero account. So it posts all the journals in the right place for you. So although it might cost you a £5 to do it, it saves you the effort of posting a journal and potentially getting that journal wrong. It allows you easily to identify the PAYE tax and national insurance contributions, which are a cost to your business, and then also you've got the time to actually pay and process those. So it is a bit faffy. You have to register as an employer, you have to run your payroll, you have to make sure everything's paid on time and in full, but it's often cheaper, tax efficiently, to run that instead of just paying everything to yourself out of dividend.
Rather spend a £5 a month than spend however many hundreds.
Yeah, I mean, there are free payroll solutions. The downside of a free payroll solution is it often sits outside your main software solution and means you're either responsible for the journal or a bookkeeper is. So you're either paying somebody else to do it for you or you're running the risk of not doing it yourself properly. So the number of times we've seen directors or payroll journals entered incorrectly, it just makes your management accounts wrong, which is not terribly helpful.
It's just one more thing to think about.
Yeah, absolutely. So make sure you use an integrated system is what we're saying.
Yeah. Whenever processing payroll, we should always be considering the sustainability of the payroll we are running. So there's a few items to consider here, and there's a few thinking points around each topic. So the first one is whether or not your business currently has cash constraints. Now, the good part about running payroll is because it's director's payroll, you can offset the resulting net pay to the DLA, and you can take the cash when it becomes available. So really handy. You don't have to take the cash immediately, and it just gives you that little bit of timing to help you manage your cash flow. Now, the main, or one of the main aspects of running payroll is the impact on the company's profits. So if you are processing a payroll, there is going to be a cost in your P&L, and you've got to consider, how does the extra cost affect your business? Does your business already generate enough profit with your payroll in place, or will actually it reduce your profitability down so that actually it then impacts your drawing potential, which is the next point. With the extra cost in your P&L, do you still have enough profit left after tax to declare any additional dividends on top of your payroll? Now, we say best to run the most tax efficient payroll to run is minimal, and of course many people require more than just the minimal payroll, of course. So of course there may be additional dividends drawn on top of this. So you've got to consider whether your company's got enough profits left after tax with your payroll in place.
Yeah, now what we have seen is occasionally, if people are running at a loss, or perhaps you're running R&D tax credits, it might be that your payroll costs are greater than the tax-free allowance to allow you to draw enough cash out of the business to pay your personal bills, but running the company at a loss, and then maybe you're reliant on R&D tax credits later. So that's okay. Works, but it's difficult to then manage the cash. So you need to be very careful if you're going to work on that basis.
And then, of course, if we do process payroll above the tax-free allowance, we will, of course, have PAYE liabilities. So if we're running payroll higher than our existing tax-free allowance for the year, we will have PAYE, which is going to be due to HMRC each month by the 19th. So can you pay it? Are you setting aside the funds?
So let's have a think about the we've got three different examples of payroll here. So these are all very small payrolls. If you paid yourself up to the tax or the national insurance threshold, so you want to pay yourself to a point where you earn your national insurance credits, but you don't actually want to pay national insurance over, then you can pay yourself £8,632 a year. That goes through your P&L, but you've got no tax and no national insurance to pay to HMRC. But the net payable amount to the director is only £8,632, which is not really a lot, is it?
No. Now, if you're running a slightly higher payroll, say 2019, 2020, your tax-free allowance is £12,500, you can run this as your annual salary. And it does not just cost £12,500 in the P&L. Now, there will not be any tax, but there will be national insurance charges, and by which I mean employers' national insurance charges, which are an additional cost to the business. Now, in this particular example of a £12,500 salary for 2019-2020, there'll be an extra £534 worth of employers' national insurance charges. So the total cost in your P&L for the year is actually £13,034. Read the wrong number. Oh dear.
Right, so say you had a £15,000 annual salary, you're going to end up paying a little bit of tax and a little bit of national insurance. So your national insurance charges in this case would be £879 for the tax year 2019 to 2020. So your total cost is actually £15,879. But you would have to pay tax to HMRC as well. So you have a small cash flow implication. So you, the director, don't get the full 15,000, you get 14,500, pay £500. In fact, you'd have to pay a little bit more than that because you pay employees national insurance as well. But the total cost to your P&L is going to be £15,879.
Then, of course, as we mentioned, you may have PAYE to pay. So we've got to consider the sustainability of our payroll from the liability perspective. So this is going to impact our cash flow, and of course, it's going to impact our cash flow slightly differently depending on who we owe the money to. So when we run a payroll, we'll have cash due to you as the director, which is classed as well, it's named your net pay. So this is physically due to you. You can either take the cash as it stands, or you can offset it against your DLA and take the cash later if you prefer to take, say, lump sums. But we will also have cash liabilities due to HMRC. Now, these are due on the 19th of each month, and it may include items such as PAYE, employees' national insurance, and employers' national insurance. Now, it's worth considering all three of these because they will all need to be paid at the same time. So, do you have the cash? Are you setting aside the funds? Really important one here. If you don't currently have a waterfalling system in place, very, very much worth considering it in these instances. So maybe have a separate bank account where you can set aside this cash. And then it just helps alleviate some of the cash constraints.
There's not a huge cash constraint when you're running a minimum director's payroll, but what does tend to happen, and what we see quite regularly, is because the tax and national insurance to HMRC is relatively small, it's not considered to be a priority, so it often gets forgotten, and then the director gets to the end of the year and then remembers that there are sort of 5, 6, 7, 8 months worth of tax and national insurance to pay. They're still relatively small sums, but they're forgotten. So they'll end up with interest charges on these that aren't necessary because you haven't perhaps remembered to pay those small amounts in time. So that's a common error with a small director's payroll that you need to look out for.
Speaking of common errors, there's actually quite a few of these which we encounter on, it depends. We encounter a few of these, some of them more regularly than others. Yeah. So the first error is simply that the director doesn't pay themselves via the PAYE scheme. So they lose out on their personal eligibility, that's a big word, for national insurance benefits. So you don't get the national insurance benefits because you're not paying yourself via payroll. Now, this usually happens when you're doing 100% dividends, and that's it doesn't make sense to why you do it, because you lose out on this really beneficial national insurance benefits, and of course you lose out on your tax deductible payroll costs in the profit and loss report, which is really, really efficient for getting the cash to you. So process payroll, make the most of it, get the most benefits out of your company.
Another mistake is for dividends to be treated as a tax deductible overhead, whereas instead they should be distributed from profits after tax. So you need to look out for those in your P&L and make sure they appear below your operating profit line, not within your overhead costs.
Now, another issue is quite simply when the company is not registered for the PAYE scheme in the first place. But if you run the payroll anyway, it's not correct, because HMRC needs to have you registered as a PAYE scheme, under the PAYE scheme, even if you have no tax due, unless, of course, you as a director earn less than £118 a week as of 2019-2020. Now, that's not a great deal of money. So generally, most people, it's common in startup, but generally speaking, it's quite easy for people to go over that threshold. So it's quite a low one there. So you may need to be registered for PAYE.
Now, another common error is that the director calls these drawings, and we see these drawings being posted to the P&L. And that's not correct either, because if you're taking money out of your company, and remembering that your company is a separate legal entity, so there's a divide, there's a line between what's yours and what belongs to the company. So these aren't drawings. They would be if you were self-employed, but if this is a company, then these are loans. So you're drawing cash out in lieu of dividends later on. So it's a loan. The company is giving you money tax-free that you then have to account for later. And it's a really common error that we see these in the P&L called drawings, or even called director salary or director's remuneration, without having put those through payroll. So look out for that. So there we are. That's our 10 minutes at 10 today. Tomorrow we're going to go into more detail on what to pay and how much to pay as a tax efficient director's payroll. So thank you for joining us today. If you've enjoyed today's video, please let us know in the comments. If you've got any queries about this video, please let us know in the comments, and we'll see you all tomorrow. Bye.
Bye.
Hi, I'm Lisa.
And I'm Harry.
And we are Chartered Management Accountants from Caseron Cloud Accounting Limited.
If you enjoyed this video, please subscribe to our channel for more videos like this.
Click on the link below to join our free Bloody Brilliant Business bookkeeping group on Facebook, where we are live every weekday answering questions, sharing stories, and building profit-generating businesses that put more cash in your pocket.
If you want to learn more, or you want to take a deeper dive into any of the topics we have covered, join the Bloody Brilliant Business Club with tutorials, workbooks, cheat sheets, and checklists which make it stupidly simple and brilliantly profitable to understand the financial stuff that you hate.
We'll see you there. Bye.
Bye.